You say that SVB was the canary in the coal mine. Are you saying then that there are fundamental reasons why all of these regional banks are selling off so precipitously?
Yes, if you look at the US banking sector, immediately after COVID, the savings increased by about 5 trillion, while the loans increased only by 2 trillion. Where would the remaining 3 trillion grow? It had to go somewhere else. 1.3 trillion went into US Treasuries, and we know very well that the US Treasuries, the market value of that decreases when the rates are increased. And the unprecedented increase of about 5% in 6 months has led to about 600 billion plus of unrealized losses. And that is the point that I'm making by saying that this is a canary in a coal mine. Many commentators are focusing on the fact that the kind of deposits that SVB had was maybe more than $250,000, which is not insured through deposits. But the crucial point to recognize is that this 650 billion plus loss is about 30% of the equity of the US banking system. That's a very large number.
I think this is something that many people have not grasped or realized, that it's been very difficult to deal with. What you're saying is there are banks with a lot of unrealized losses because the value of all those treasuries and mortgage-backed securities they held has gone down, and now yields are up. What's the next step here?
So the Fed has, last week come up with this program where they're trying to, in my opinion, kick the can down the road. The program essentially enables banks to borrow by, using the discount window, by depositing these securities not at the market value, but at the face value. But all that does is essentially postpones the problem. It does not solve the problem. And as we are seeing, many of these small banks, the regional banks, some of the community banks, there are deposits that are getting withdrawn from there, and they're going into the large banks, which means that the depositors are not convinced that the crisis is over. And this will have important ramifications for the common Americans, because a lot of the common Americans, the small firms especially, bank with these small banks, the community banks, and those are in stress. I think we'll have to wait and watch, because 30% of the bank equity in stress is a large number.
We have seen Treasury Secretary Janet Yellen pushing back on the idea of a complete guarantee of US bank deposits. What's more important at this point, achieving medium-term stability in the financial sector given the ongoing turmoil, and as you say, an ongoing credit event in the future has huge ramifications, or is it more important to discourage this idea that we're worsening moral hazard here?
So I think that the $250,000 threshold is large enough. If you think about the average American, that is about 4 or 5 times their annual income, the median American. So $250,000, if somebody has more than $250,000, I don't think we would classify such a person or such a household as poor. So in order to ensure that the moral hazard does not get exacerbated, I don't agree that there should be an increase in the threshold for deposit insurance. But I think what is critical is for the Fed to realize that the rate hike cycle has to end, because further increases in the policy rate will only mean even more unrealized losses, and that will also affect many of the banks that are possibly unhedged. While the problem is being postponed, at some point you have to unmount the tiger.